Our next topic is on deferrals. These will be a little more complicated than the accruals because most of these transactions you have not done already. The two deferrals are unearned revenues and prepaid expenses. We will begin by covering unearned revenues first. Unearned revenues are when cash is received in advance of providing the product or service. Examples include rent, airline tickets, and customer deposits, to name a few. Think of an airline. Don't you have to purchase your ticket before your flight? Yes, we all do. We cannot pay after the flight, but we have to pay before. Airlines consistently have unearned revenues. If you purchase a ticket and pay the airline still has to provide you with the service. I brought this up last chapter briefly, where unearned revenue accounts are liabilities. The airline's work is not done. They still need to pay pilots, attendants, maintenance workers. They still need to clean the plane and purchase fuel. If the airline cannot do this, they will need to give you your money back. Here is the same timeline. For deferrals, they will work opposite of accruals. Accruals have the revenue or expense first, with the cash later. Deferrals will have the cash first and the revenue or expense later. Remember, we are not concerned with the cash transaction. When journalizing adjusting entries, we are concerned with either the revenue or expense entry. First, we will receive cash early. At a later date, we will provide the service or product to the customer. This is when we record it as revenue. It is not revenue when we receive the cash, it will be revenue once we complete the sale or service. This adjusting entry involves debiting an unearned revenue account and crediting a revenue account. This is a little confusing because we are concerned with the second entry and not the first. The first entry, when cash is received, would be a debit to cash and a credit to unearned revenue. Unearned revenue is a liability account and has a credit balance. Therefore, when we receive the cash, we will put the liability on our books. Now, fast forward to the second entry when we provide the service. We no longer have a liability. Once we complete the sale, we no longer owe anything to the customer. We will remove the liability from our books by debiting the liability account called unearned revenue. We will credit a revenue account because we can now officially include the sale as revenue on our books. Let's do an example to illustrate this. This is number 4 on your classwork. The Kroeger company collected $6,000 rent in advance on November 1st, debiting cash and crediting unearned rent revenue. That's the first transaction, but that's the one we're not concerned with. The tenant was paying 12 months rent in advance and occupancy began November 1st. What is the adjusting entry on December 31st? As you can see, the first transaction was done when we received the cash. We debited cash and credited the unearned rent revenue account, thus putting a liability on our books. Remember, we are not concerned with the cash transaction here. What we want to do is update the accounts to show that we earned some of this revenue as time had passed. This one is a little trickier because it is not a full time period. We received $6,000 on November 1st, and it is prepaid for 1 full year, meaning that the rent is prepaid until October 31st of the following year. The issue is that we are preparing our adjusting entries and financial statements on December 31st. Some of this revenue was earned this year and some of it for next year. We need to do a little math in order to figure out the revenue for this year. Since the $6,000 is for an entire year, if we divide by 12, we get $500 per month. How many months have passed from November 1st to December 31st? It was 2 full months, all of November and all of December. If it's $500 a month and 2 months have passed, how much revenue did we earn this year? It would be $1,000 this year and $5,000 in the following year, for a total of $6,000. Now that we know the amount to journalize, which is the $1,000, let's do the entries. The date is 12/31. Remember, we debit an unearned revenue account. The account we will use here is unearned rent revenue because it is rent that we are receiving. Remember, this debit removes the liability from our books. The amount we calculated below is $1,000. The credit will be a revenue account because now we have actual revenue. We will use the rent revenue account. The amount of $1,000 is the same. I know this took a little longer and seems confusing. Just remember, when you recognize this adjusting entry for unearned revenue, you will always debit the unearned revenue account, credit a revenue account for the amount that was earned in this time period. Next, we have prepaid expenses, which is even more complicated than unearned revenue. This is because there are a few different types of entries here. We will cover 3 different examples. Prepaid expenses are when cash is paid in advance of receiving their benefits. This business will pay for an expense and it will be used later. Examples include prepaid insurance, prepaid rent, supplies, and depreciation. Looking at the timeline, we first pay for the expense or asset. Later, we use it. When we use it, that is when we will recognize the expense on our books. The adjusting entry involves debiting an expense account and crediting an asset account. We debit the expense account to put the expense on our books, and we credit the asset account to reduce it by what we used during that time period. We are going to do 3 different examples next. Our first example is number 5. On July 1st, 2017, Lopez Company paid $1,200 for 6 months of insurance coverage. What is the adjusting entry on December 31st? Remember, we are not concerned with the July 1st entry. We can assume that that was already done correctly. If we prepaid insurance for 6 months, then the July 1st entry would be a debit to prepaid insurance and a credit to cash. Remember, the prepaid expense accounts are assets because they are still worth something. You can either cancel and get your money back or use it, in which we'd have the next 6 months of this expense paid for already. It is worth something. Now, it is December 31st, and we do not have $1,200 worth of a prepaid expense anymore because we used it over these last few months. How much of the $1,200 do we have left? It's actually nothing. From July 1st to the end of December, 6 months have passed, which is the amount of months that we prepaid. We would need to purchase another policy to continue having insurance. The journal entry we are making needs to record the expense and show that the asset has been reduced to nothing. The date of this entry is December 31st. What expense have we used over the last 6 months? Insurance. We will use the insurance expense account. How much insurance did we use over the last 6 months? Like I said, it was all of it. All $1,200 we will record as an expense. Next, we will credit the asset account. The asset in this case is prepaid insurance. We need to reduce this account by the amount we used over the period, which is all of it. On July 1st, we put $1,200 into this account, and on December 31st, we take it out, showing a balance of 0. Another example for this type could be rent expense and prepaid rent. The next example I will show is regarding a different type of asset other than the prepaid expenses. We will look at supplies. Before we begin, I just want to let you know that in the real world, I usually don't see this transaction done this way. Many bookkeepers will expense the entire amount when they purchase the supplies. However, this is the correct way of making this entry. Zim Company has a supplies account balance of $5,000 on January 1st, 2017. During 2017, it purchased $2,000 of supplies. As of December 31st, 2017, a supplies inventory shows $800 of supplies available. What is the adjusting entry on December 31st? We still need to debit an expense account and credit an asset account for the amount we used during this time period. In this case, we had $5,000 of supplies plus the purchase of 2,000 more. We had a total of $7,000 worth of supplies. The inventory count shows that we currently have $500 worth of supplies on hand. How much did we use during the year? It would be the difference between what we had and what we have. 7,000 minus $800 equals $6,200. We used $6,200 worth of supplies during this time period. When making the journal entry, we still use December 31st as the date. The expense account that we would be using is supplies expense. This is to record the amount of supplies we used during the year. The amount will be the amount we used, which we calculated as $6,200. Next, we credit an asset account. Which asset are we using here? Supplies. We need to bring the supplies account down by $6,200. It was at $7,000, but we don't have that anymore. We only have $800 on hand. We need to subtract $6,200 from that account, so the balance is now at $800. Our last adjusting entry for prepaid expenses is depreciation. This is a very important topic to learn. Even if you decide not to go into accounting, depreciation is something you may still encounter in your business career. Now, depreciation may mean something different than what you are used to. Most of my students think of depreciation as the decrease in value of an asset. For example, your car. Your car depreciates in value over time. In accounting, it is similar, but not quite the same. We are not revaluing the asset. Instead, we are expensing the amount we paid for that asset as an expense over its useful life. In Chapter 10, we cover this in more detail, along with the different methods. When we buy an asset, say a car, we put the car in our books for the full amount we paid. We will expense what we spent on the car over several years. We do not expense it all in one year because we're using it over many years. I will probably expense a car over 5 years. For now, we're going to learn one way of calculating depreciation, which is the straight line method. We will learn the other methods in Chapter 10. The straight line method is taking the cost of the asset, subtracting the salvage value, and dividing by the useful life. These numbers will all be given to you. You just need to do the math. The salvage value would be what the asset is worth at the end of its life. If it's worth anything at all, we don't just throw away the car or leave it on the side of the road, we will sell it. When we use this formula, we will be able to calculate the depreciation expense for a year. There is a lot more to this topic that we will cover in Chapter 10, but for now we're just keeping it simple by calculating depreciation for a full year. Now, normally in class, I play you another YouTube video that goes over depreciation a little bit more. I included this link on the Learn Chapter 3 page after this video. The adjusting entry involves debiting depreciation expense and crediting accumulated depreciation. Now, let me give you an example before we practice on what this all means. Let's say we purchased a car for $60,000. We will use the car for approximately 5 years before purchasing a new one. We are estimating that the car will be sold for $10,000 at the end of the 5 years. We will use the formula to calculate the depreciation expense each year. We will take the cost of the car less the salvage value divided by the amount of years. It would be $60,000 minus the $10,000 divided by 5. This will equal $10,000 of depreciation per year. Depreciation expense will be debited each year until the full amount of the asset will be expensed. We will record depreciation of $10,000 each year for 5 years. Now the credit will be this new account called accumulated depreciation. This account is a contra asset account. A contra account means the normal balance is on the opposite side. Since assets have a normal balance of a debit, The accumulated depreciation account has the opposite normal balance of a credit. It is still in the asset section though, but will reduce the value of that asset. The two accounts are linked together. We have the asset on the balance sheet for 60,000. Below that, we will have the accumulated depreciation account. This account will just keep accumulating the depreciation amount each year. After 1 year, the accumulated depreciation will be $10,000. The second year will be $20,000. The third year, $30,000, and so on. The value of the asset on the balance sheet will be the book value. That's what this is called. After the first year, the book value will be $50,000. Now that I've given you a little example, let's practice together. This is number 7 on your classwork. Varga Company purchases $20,000 of equipment on January 1st, 2017. The equipment is expected to last 5 years and be worth $2,000 at the end of that time. What is the adjusting entry on December 31st? First, let's use the formula to calculate how much a depreciation is each year. We start off by doing 20,000, which is the cost, minus 2,000, which is the salvage value, divided by the useful life, which would be 5 years in this case. When we do this math, we get $3,600 worth of depreciation each year. Now, let's do the journal entry. The date is the same as it's been in all of our other examples of December 31st. Remember, when we have depreciation, the debit account will be depreciation expense, and we do label it what we're talking about. In this case, it's equipment. The amount would be the amount we just calculated, $3,600. Now the credit is that new account, accumulated depreciation. Remember, this is the contra asset account. It will reduce the value of the equipment. We do it for the same amount, $3,600. As you can see, the deferrals are definitely more time consuming and more involved than the accruals. So just make sure you practice these over and over again.